Gas prices just posted their biggest single-month jump in over 60 years. That one line explains why March CPI came in at 3.3%, and why the Federal Reserve is now in the tightest corner it has occupied since 2022. The chain runs through the Strait of Hormuz. When Iran blocked tanker traffic in late February, global crude supply tightened almost overnight. By March, gasoline alone added more than half a percentage point to the headline inflation number. The Bureau of Labor Statistics confirmed it, a 0.9% monthly gain in the All Items Index, the largest since the Biden-era surge 4 years ago. What makes this different from a standard commodity shock is the secondary layer. Iran is now demanding crypto payments, Bitcoin and USDT, from oil tankers seeking passage through the strait. The Islamic Revolutionary Guard Corps has collected an estimated $2 million since mid-March. That is not yet large enough to move markets on its own, but it signals that the disruption is not simply tactical. It is structural, built into how Iran plans to monetize the choke point long-term. The Federal Reserve's problem is clean to state and nearly impossible to solve. Inflation is high because of an oil shock that has nothing to do with demand. Rate hikes cannot lower gas prices, but rate cuts now would validate the idea that the Fed blinks whenever geopolitics gets messy. Fed Governor Mary Daly said it plainly this week. An oil shock means getting inflation down simply takes longer. Traders heard that and adjusted. Bond markets are now pricing in near zero probability of a cut before September, and one Fed official explicitly put a rate hike back on the table as a tail risk. Consumer sentiment collapsed in parallel. The University of Michigan's April headline index fell to 47.6, a record low, down more than 10% in a single month. One-year inflation expectations jumped to 4.8%. Survey respondents specifically blamed the Iran conflict for deteriorating conditions. The survey director noted that most of the interviews were completed before the April 7th ceasefire, which means the worst of the panic is already behind this reading. But spending decisions made in fear do not reverse the moment a ceasefire is announced. The ceasefire itself is fragile. Bombing continued for days after the deal was struck. Hormuz traffic is still at a fraction of normal volume. Mortgage rates fell the first week after the ceasefire, but oil prices have not fully corrected. If the ceasefire folds through April and supply flows normalize, the energy component of CPI reverses sharply. Gasoline contributed disproportionately, and it can give back just as fast. That is the recovery scenario. A single sustained month of falling gas prices could cut CPI by half a percentage point and give the Fed room to signal cuts again by summer. If the ceasefire fractures, or if Iran formalizes the tool system at scale, energy inflation embeds for a second quarter, and the Fed's next move becomes a genuine coin flip between holding and hiking. On the same day that CPI printed its worst monthly gain in years, CoreWeave stock rose 13%. That collision is not a coincidence. It is the clearest single-day expression of how the AI infrastructure trade is decoupled from the macro environment it sits inside. CoreWeave announced a multi-year agreement with Anthropic, making Anthropic the latest addition to a customer list that now includes 9 of the top 10 AI model providers globally. The deal came one day after Meta committed an additional $21 billion to CoreWeave, on top of a $14 billion commitment from September. CoreWeave did not disclose the Anthropic contract value, but Anthropic separately disclosed this week that its annual revenue run rate has now crossed $30 billion, up from $9 billion just at the end of 2025. That is a tripling in roughly 4 months. The infrastructure logic is straightforward. Anthropic's Claude Code product has exploded in usage. The company needs physical GPU capacity at a scale that even its own data center build-out cannot match in time. CoreWeave operates hundreds of thousands of NVIDIA GPUs across its data centers and can allocate capacity on a multi-year contract basis. Microsoft, Google, and OpenAI all use CoreWeave for the same reason. GPU demand is growing faster than any single hyperscaler can provision on its own. Amazon CEO Andy Jassy put numbers to this dynamic in his shareholder letter this week. AWS AI revenue is already running above $15 billion annually in the first quarter alone, and Jassy said AWS would be growing even faster if not for capacity constraints the company is actively working to resolve. Amazon announced planned capital expenditures of roughly $200 billion for 2026, a number that shocked investors until Jassy clarified that customer commitments already underwrite a substantial portion of that capacity. The risk in this trade is leverage. CoreWeave held $21 billion in debt at the end of 2025 and added another $8.5 billion in March. It is now raising $3 billion more to fund the Meta deal. Every incremental AI contract adds revenue visibility, but also adds financing complexity. If AI model demand plateaus, or if the hyperscalers bring enough internal capacity online to reduce their dependence on neo-cloud providers, CoreWeave's dead load becomes the story rather than its customer wins. NVIDIA sits at the center of this chain, and NVIDIA's position is genuinely strong but not immune to erosion. CEO Jensen Huang projected at least $1 trillion in combined Blackwell and Vera Rubin sales through 2027. Taiwan Semiconductor is rapidly expanding its CoWoS packaging capacity, which supports Huang's forecast, but it also means GPU scarcity. The mechanism that has supported NVIDIA's pricing power and gross margin will gradually fade. The company's largest customers are all building internal chips. The revenue forecast may prove accurate while the margin story quietly compresses. Two stocks ended this week at opposite extremes of the same market, and the gap between them describes the real fault line in 2026 equities. Tesla is heading into its 8th consecutive weekly loss. The stock is down more than 20% year-to-date, has broken a key technical support level, and is entering April earnings on April 22nd with no credible catalyst in sight. China sales fell 16% year-over-year in the first quarter. The Optimus robot has not shipped to any commercial customer. Robotaxi operations in San Francisco and Austin still require safety drivers. The options market is not pricing for a recovery, it is pricing for more volatility. Meanwhile, NVIDIA extended its winning streak to 8 sessions, its best run since 2023. Meta gained more than 6% Wednesday after launching Muse Spark, its first frontier model from its new superintelligence labs. Amazon jumped nearly 14% over the week on the shareholder letter alone. The divergence is not just about which companies are doing well, it is about which investment thesis is working. Tesla was once the AI and autonomy trade. It is no longer perceived that way by the market. The same investors who moved capital into CoreWeave and Amazon this week were not buying Tesla on the dip. That rotation has a structural quality to it. Tesla's AI story depends on proprietary hardware and vehicles, while the infrastructure trade depends on data centers, chips, and model capacity, and the data center story has concrete revenue to show for it now. The synthesis that ties all three threads together is the conditional nature of everything that follows from here. Inflation stays elevated only if Hormuz stays disrupted. The AI capex boom stays credible only if enterprise AI adoption keeps accelerating into 2027 at the pace Jassy and Huang are projecting. And the market's willingness to keep repricing AI stocks higher depends on a Fed that stays on hold rather than hiking, which itself depends on energy prices, which depend on the ceasefire. The weight of the evidence points toward a continued bid for AI infrastructure names through the second quarter, with the key condition being that the ceasefire holds long enough for energy prices to pull back at least partially. If oil retreats by $10 to $15, core CPI likely comes in softer in April, the Fed stays on hold, and the risk on bid in AI stocks continues. If the ceasefire collapses before oil normalizes, the inflation trade reasserts itself, rate hike probability climbs back above 20%, and the market's willingness to pay a premium for long-duration growth assets, which is exactly what AI infrastructure names are, faces a structural test. The specific benchmark to watch, the April CPI report releases in mid-May. If the energy component reverses there, the second half of the script rewrites itself in a more constructive direction. If it does not, the question shifts from when the Fed cuts to whether it ever does this year. The leaning could be wrong if the ceasefire holds but Iran formalizes tolls at scale. That scenario combines lower oil prices with persistent structural supply risk, and it has no clear market precedent to price against.